There's a uniquely American trap that catches millions of young people every year. It promises opportunity, demands sacrifice, and delivers bondage. It's marketed as investment in your future, but functions as a tax on ambition. It's presented as the gateway to the middle class, but increasingly becomes the barrier that keeps you out. We're told it's the price of education, the cost of betterment, the necessary sacrifice for success. But the truth is darker and simpler. Student debt isn't a side effect of America's education system, it's the business model, and it's one of the most profitable schemes ever devised, a machine that extracts wealth from the young, the hopeful, and the desperate, and funnels it upward to banks, loan servicers, and ultimately the federal government itself. Understanding how we got here, how education debt went from barely existing to crushing 43 million Americans under $1.8 trillion in obligations, requires looking past the rhetoric about opportunity and investment to see the deliberate policy choices that transformed higher education from a public good into a profit center. The story begins not with greed but with fear. In 1957, the Soviet Union launched Sputnik, the first artificial satellite, into orbit. The achievement shocked Americans who had assumed their technological superiority was unquestionable. Suddenly, the Cold War wasn't just about armies and nuclear weapons, it was about science, engineering, and education. If the Soviets could put a satellite into space, what else could they do? The fear was existential. America needed more scientists, more engineers, more educated workers to compete with the communist threat. But higher education was expensive and accessible primarily to the wealthy. Most Americans couldn't afford college, which meant talent was being wasted, potential squandered. The solution came in 1958 with the National Defense Education Act, which created the first federal student loan program. The name itself reveals the motivation. This wasn't primarily about helping students or promoting equality. It was about national defense, about producing the educated workforce necessary to win the Cold War. The program was limited, targeting specific fields like science, engineering, and foreign languages. If you wanted to study those subjects, the government would lend you money at low interest rates, and if you went into teaching or public service after graduation, part of the debt would be forgiven. It was a targeted intervention designed to address a specific problem, and by that measure, it worked. Enrollment in technical fields increased. American universities became centers of scientific research, and a generation of scientists and engineers helped put Americans on the moon. But the program established a precedent that would have consequences nobody anticipated. For the first time, the federal government was in the business of lending money for education, and once that door opened, it would never close. The Higher Education Act of 1965, passed as part of President Lyndon Johnson's Great Society programs, dramatically expanded the concept. Student loans were no longer limited to defense-related fields. Any student attending an accredited institution could borrow, and the government would guarantee those loans. This was revolutionary. Banks had been reluctant to lend to students because there was no collateral. You couldn't repossess an education. Default risk was high, but with government guarantees, banks faced no risk. If a student defaulted, the government would pay the bank back. The risk was transferred from private lenders to taxpayers. The logic seemed sound. Education was the pathway to opportunity. If financial barriers prevented talented students from attending college, society lost their potential contributions. By making loans available, the government would democratize higher education, allowing anyone with ability to attend regardless of family wealth. And because college graduates earned more than non-graduates, they'd easily repay their loans from higher lifetime earnings. It was supposed to be win-win. Students would gain opportunity, society would benefit from a more educated workforce, and the government would get its money back with interest. For a while, it actually worked that way. In the 1960s and 70s, college was relatively affordable. Tuition at public universities was low, often just a few $100s per year. Many students could work part-time and graduate with little or no debt. Those who did borrow typically owed modest amounts, a few $1,000s that could be repaid within a few years of graduation. The student loan program was functioning as intended, helping students who needed it without creating crushing debt burdens. But the seeds of the crisis were already planted, embedded in the structure of the system itself. The problem was that government-guaranteed loans removed market discipline. In a normal loan market, lenders assess risk and price interest accordingly. Risky borrowers pay higher rates, safe borrowers pay lower rates, and lenders have an incentive to ensure borrowers can repay because they bear the loss if loans default. But student loans worked differently. Banks made the loans but bore no risk because the government guaranteed repayment. This meant banks had no incentive to assess whether students could actually repay. They could lend unlimited amounts to anyone attending an accredited school, regardless of that student's field of study, likely earnings, or ability to repay. The loan was risk-free for the bank, so they made as many as possible. Universities noticed. If students could borrow unlimited amounts, universities could charge more. As long as loans covered tuition, students would keep enrolling. And because universities were competing for students, they began spending money on amenities, facilities, administrative staff, and everything except keeping costs down. The result was predictable. The 1978 Middle Income Student Assistance Act removed income restrictions, making loans available to families at all income levels, not just the poor. This flooded the system with money. Enrollment surged, and tuition began rising faster than inflation, faster than wages, faster than any rational measure of cost increases. By the 1980s, the pattern was clear. Every time the government expanded loan availability or increased borrowing limits, tuition rose to absorb the new money. Economists call this the Bennett Hypothesis, named after Reagan-era Education Secretary William Bennett, who observed that increases in financial aid enable colleges to raise tuition. The mechanism is straightforward. When students have more money available through loans, universities can charge more without losing enrollment. It's not malicious, it's rational behavior by institutions competing for resources and prestige. But the result is that increased loan availability doesn't make college more affordable. It makes it more expensive. Students end up borrowing more, not because education costs more to provide, but because universities charge more because students can borrow more. It's a feedback loop that benefits universities at the expense of students. The 1990s accelerated everything. The federal government created unsubsidized Stafford loans, which, unlike previous loans, accumulated interest while students were still in school. This meant that by the time you graduated, you owed more than you borrowed. The government also raised borrowing limits repeatedly, allowing students to take on ever larger debt loads. Graduate programs became loan-financed. Professional schools like law and medicine, which had been relatively affordable, began charging eye-watering tuition because they knew students could borrow six figures. The entire higher education sector was becoming financialized, running not on tuition paid from family savings or earnings, but on borrowed money that students would spend decades repaying. Then came 1998 and the single most consequential change to student loans in their history. The Higher Education Amendments of 1998 made student loans nearly impossible to discharge in bankruptcy. Previously, student loans were treated like other unsecured debt. If you declared bankruptcy, your debts could be forgiven, giving you a fresh start. But the 1998 law changed that, requiring borrowers to prove undue hardship to discharge student loans in bankruptcy, a standard so high that courts almost never granted. You can discharge credit card debt, medical debt, business debt, even gambling debt in bankruptcy. But not student loans. They follow you for life. The rationale was preventing abuse, the concern that students would borrow for college, graduate, immediately declare bankruptcy, and walk away from the debt with a degree and no consequences. But the actual effect was to make student loans uniquely inescapable and uniquely profitable, because if borrowers can't discharge the debt, lenders face virtually no risk. Default becomes almost meaningless because the debt remains, growing with interest and penalties, following borrowers forever. Wages can be garnished, tax refunds can be seized, Social Security benefits can be reduced, there's no statute of limitations, no escape, no fresh start. The debt is eternal. This change transformed student loans from a somewhat risky investment into the safest investment in existence. Safer than mortgages because houses can lose value. Safer than auto loans because cars depreciate. Safer than corporate bonds because companies can go bankrupt. Student loans were guaranteed by the government and couldn't be discharged by borrowers. They were perfect from a creditor's perspective and a nightmare from a borrower's perspective. And the profit margins became extraordinary. Enter Sallie Mae. Originally created in 1972 as a government-sponsored enterprise to provide liquidity to the student loan market, Sallie Mae was privatized in 2004, becoming a for-profit corporation while retaining its dominant position in student lending. The company became fabulously profitable by issuing student loans, collecting payments, and pursuing anyone who fell behind with aggressive collection tactics. Sallie Mae charged high interest rates, often 6 to 8% or more, on loans that carried virtually no risk because they were guaranteed and non-dischargeable. The company's executives made millions. Its shareholders earned healthy returns, and borrowers, many of whom had borrowed as teenagers without fully understanding the terms, found themselves trapped in decades of payments. The 2000s saw student debt explode. total outstanding student loan debt was $521 billion in 2006. By 2010, it exceeded credit card debt for the first time in American history, surpassing $830 billion. By 2020, it topped $1.7 trillion. Today, it stands at $1.8 trillion, with 43 million Americans owing an average of $37,000 each, though many owe far more. Graduate students account for nearly half of all debt despite being a smaller portion of borrowers, with many owing $100,000, $200,000, or more. The crisis isn't just that people owe money, it's that the amounts are unpayable, that interest accrues faster than many borrowers can pay it down, that people in their 40s, 50s, and 60s are still paying for degrees they earned decades ago. And here's the most disturbing part. The federal government profits from this system. Unlike other federal programs that cost money, the student loan program generates revenue. The government lends at interest rates higher than its borrowing costs, and because the loans are non-dischargeable and backed by the government's collection powers, default losses are minimal. In recent years, the government has made billions annually in profit from student loan interest, more than Exxon, more than Apple, more revenue than many Fortune 500 companies. The Department of Education has become a profit center extracting wealth from young people trying to better themselves. The consequences are devastating and widespread. Graduates delay buying homes because they can't save for down payments while making student loan payments. They delay starting businesses because they can't take entrepreneurial risks with debt hanging over them. They delay having children because they can't afford to raise families while repaying loans. They delay saving for retirement, meaning they'll be financially insecure in old age. Student debt has become a generational anchor, preventing millions from building wealth, contributing to falling homeownership rates among young adults, declining birth rates, and rising economic anxiety. The burden falls disproportionately on women, minorities, and first-generation college students, the very group student loans were supposed to help. Black graduates owe more on average than white graduates and are more likely to default. Women hold 2/3 of all student debt despite earning less than men. Students from low-income families borrow more and struggle more to repay. The system promised opportunity but delivered a poverty trap. Students borrowed believing education would lead to good jobs and financial security. But wage growth has stagnated even as debt burdens increased. The jobs that exist often don't pay enough to both repay loans and live comfortably. Teachers, social workers, and nurses, professions we claim to value, face some of the worst debt-to-income ratios because their salaries haven't kept pace with the cost of the degrees required to enter those fields. For-profit colleges made everything worse. These institutions, operated by corporations to generate profits for shareholders, aggressively recruited low-income students, veterans, and minorities with promises of career training and good jobs. They encouraged students to borrow the maximum amount available, far more than necessary because the schools got paid whether students graduated or succeeded. Many students left with worthless degrees or credentials, unable to find the jobs they'd been promised, but saddled with enormous debt. Some for-profit colleges closed abruptly, leaving students with debt but no degree. And because the loans were federal and non-dischargeable, students were trapped. Several for-profit chains faced lawsuits, investigations, and closures for predatory practices, but the debt remains on former students who were victims of fraud. The federal government's response has been inadequate at best. Income-driven repayment plans allow borrowers to cap payments at a percentage of income and promise loan forgiveness after 20 or 25 years of payments. But these programs are complex, poorly administered, and many borrowers find that their monthly payments don't even cover interest, meaning their loan balances grow despite making payments. Public Service Loan Forgiveness, created in 2007, promised to forgive loans for borrowers working in public service jobs after 10 years of payments. But the program was so mismanaged that 98% of applications were initially rejected due to technical issues, paperwork problems, or loan servicers providing bad information. Borrowers who believed they were on track for forgiveness after a decade discovered they'd been lied to. The COVID-19 pandemic brought temporary relief. In March 2020, federal student loan payments were paused and interest rates set to 0%. The pause was extended repeatedly through September 2023, providing over 3 years of relief. During that period, borrowers could focus on other financial needs, pay down other debts, or build savings. Some borrowers saw their debt decrease for the first time in years because payments could go entirely to principal with no interest accruing. It was a glimpse of what life without student debt pressure could look like. President Biden attempted broader relief, announcing in 2022 a plan to cancel up to $10,000 in federal student loan debt for most borrowers and up to $20,000 for Pell Grant recipients, targeting relief to those who needed it most. It would have been the largest student debt cancellation in history, helping tens of millions of borrowers. But the Supreme Court struck down the plan in 2023, ruling that Biden lacked authority to cancel debt without congressional approval. The decision left millions disappointed and millions more cynical about the possibility of reform. The fundamental problem remains unsolved because too many powerful interests profit from the current system. Banks and loan servicers make billions servicing debt. Universities have no incentive to lower costs because students can borrow to cover tuition. The government makes money from interest payments, and politicians face opposition from those who already paid their loans and see cancellation as unfair. The coalition supporting the status quo is stronger than the coalition demanding change, even though the status quo is destroying the financial futures of millions of Americans. The comparison to other countries is damning. Germany, Norway, Finland, and others provide free or nearly free higher education, funded through taxes and treated as a public good like K-12 education. Their graduates enter the workforce without debt, can buy homes younger, start businesses, and contribute economically immediately. Even countries that charge tuition keep it reasonable, a few $1,000s annually rather than tens of thousands. The United States stands nearly alone in treating higher education as a private commodity to be financed through debt rather than a public investment in human capital. The historical trajectory is clear. Student loans began as a well-intentioned program to expand opportunity during the Cold War. They worked when college was affordable and debt was modest. But over decades, the system was corrupted by perverse incentives. Guaranteed loans removed risk from lenders, encouraging reckless lending. Universities raised tuition because students could borrow more. Bankruptcy protections were stripped away, making the debt inescapable. And the government discovered that student loans could be profitable, generating billions in revenue. What started as opportunity became exploitation, a system that profits from the ambitions and dreams of young people. The dark history of student debt in America is the story of how a policy meant to help became a trap, how opportunity morphed into obligation, and how an entire generation was sold a lie. They were told education was the path to the middle class. They were told debt was good debt, an investment that would pay for itself. They were told hard work and a degree would guarantee success, and they borrowed, trusting that the system wouldn't fail them. But the system did fail them. It trapped them in debt they can't discharge, can't outrun, and often can't fully repay. It transferred wealth from young people at the start of their careers to banks, loan servicers, and the federal government. And it continues year after year with over 1 million new borrowers taking on debt that history shows they likely won't be able to comfortably repay. The question now is whether America will continue this exploitation or choose a different path. Will we treat education as a public good worth investing in, or as a commodity to be financed through private debt? Will we cancel existing debt or let it continue crushing millions? Will we regulate tuition and break the feedback loop between loan availability and rising costs? Or will we continue the dark history, sentencing each new generation to decades of debt for the crime of seeking education? The answers matter not just for individuals with student loans, but for the economy and society. An entire generation locked in debt, unable to buy homes, start businesses, or save for retirement represents a massive economic drag. Their spending power is diverted to loan payments. Their entrepreneurial potential is locked away. Their political engagement is shaped by financial anxiety. The student debt crisis isn't just a personal problem for millions of borrowers. It's a national problem with implications for growth, inequality, and the future of American prosperity. If this gave you a new perspective, hit subscribe. History doesn't repeat, but debt always collects, and an entire generation is waiting for answers that may never come.